Welcome to all of you to another episode on REITs by reitspro.com. I'm Gaurav Jain and I'm author and a trainer, and these are the two books that you can get hold of if you visit our website and get many more insights on REITs and InvITs in India, as well as real estate investing and financial analysis in India. So today the topic is, if you are a serious debt investor or a serious equity investor, maybe REITs are not for you. And by REITs I mean Indian REITs and also Indian InvITs. A lot of times we are presented this kind of an understanding that REITs are a hybrid product with a mix of debt and equity, which is obviously to a large extent true. However, this can actually be an altogether different product if you look at the use case of it, and this has to be seen with a different lens. The need for understanding it with a different lens is because a lot of times we try to make out whether to allocate something to REITs from debt or from equity from this kind of a chart that we have. However, we will cover it in a different way and in three parts. Part 1 will talk about the need gap that it actually can fulfill, where you can enjoy the investing in REITs. The second part talks about a REIT, a debt investor, which looks at REIT shortcomings from that point of view. And the third part talks about equity investors and REIT shortcomings from the equity investor point of view. So coming to the first part, let's be very specific about the needs that REITs seek to fulfill. And that can change the entire way you allocate your assets from your portfolio. So the worldwide view of matured REIT and InvIT investors is that you need to consider REITs as a separate asset class. Most people talk about REITs as a diversification tool in their existing portfolios, and thirdly, it's about inflation hedging in the longer run for your portfolio. So that, if I were to talk about REITs in one word, REIT is about giving stability, and with stability I mean three ways of providing stability. So if you look at the type of financial statements, you would come across, say, a balance sheet, income or the profit and loss account, and the cash flows. So we are talking about the stability here when we talk about your portfolio. We are talking about the stability here in income when we talk about the real income and not nominal income. And thirdly, we talk about the cash flows. Here REITs give quarterly cash flows. So let's talk about the first stability, which is on the portfolio, on the balance sheet, or your balance sheet, the portfolio. Let's talk about that first. So if you look at it, this diagram has already been presented, and should you separate out REIT investing? That is what is important, because it has a low correlation with other assets. So it's, instead of allocating parts of it and saying that, okay, I've made an allocation of a certain percentage of equity and debt in it and I am having a hybrid product, it's better to look at it as a separate asset with a low correlation with other assets. Seen in case of National Stock Exchange and SEBI both, which classify REITs and InvITs separately. They are not clubbing it under, say, corporate bonds, or they're not clubbing it under equities in any of these scenarios. So they do have a different classification as an asset. Then the second part, we talk about the stability of REITs as far as the income is concerned. So here we are talking about the real income and not nominal income. That's what the stability comes from. So if you look at this is a very important diagram which can tell you the crux of inflation hedging for real estate investment trusts. So if you look at this line, the red line is the inflation line, and this is the line for debt. So over a period of time, what happens is, if you invest a certain portion in debt, you would probably get a little higher than what a REIT is giving. So if I were to invest in a REIT with these incomes, if these are the incomes of REIT and this is the income from debt, then over a long period of time you can have debt losing out to inflation, because the return from debt, the Y denotes the income from debt would be a constant, Where in case of REIT, as we've explained in earlier videos, the income tends to increase over a longer time frame. So here REITs beat inflation. The yellow line versus the inflation, it's going to beat inflation as the incomes keep rising, and in the case of debt, the debt part would lose to inflation in the longer run. The third part is the stability of REITs and the cash flows, and today in India, REITs and InvITs both give you quarterly incomes. So if you see the earlier video on Brookfield Trust, we've explained how quarterly distributions are given out by most of the REITs in India today. So part 2 is about debt investors and how they can see REIT shortcomings and what will not suit them for REITs. So 3 must-haves for a debt investor is fixed returns. The second thing that they talk about is the YTM calculation. So if you hold it till maturity, a debt instrument, what will it give? And the third part is the duration calculations. Now, a lot of these features are lacking in REITs. For example, the fixed returns are not there in REITs. Promised returns are not there in REITs. And as you would have seen, the DPU in Brookfield dipped this time, this quarter. In fact, in Indigrid, it's been rising over a period of time. So there are no fixed returns. Now, the second part is the YTM calculations. There is no YTM calculation. Why? Because it's the instrument is an infinite instrument in all sense. So the market determines what the price is. There is no maturity date. And the third is duration calculation. There is a market price, so there is no fixed return at the end. So there cannot be a duration calculation. So you can, if you are not sure of what duration is, you can search out on the net and see what duration calculation is about. The next thing that a debt investor can probably think about is in REIT is that there's an inverse interest relationship of REITs to the interest part. The interest would have an inverse relationship. Yes, that's a short-term behavior, but there are lots and lots of other asset dynamics, and that's not so simple. So for a debt investor, this can become a hindrance because it's not a very straight and simple equation. If you're liking the content, please do subscribe to us. Do encourage us by subscribing to us actively. If you want to know more about REITs in depth, you can also visit our website, and all these resources are there. A message board is there. It's all about Indian REITs and InvITs on our website. Do visit it and take benefit of all the resources that are there. So the third part talks about equity investors and the shortcomings that they see in REIT investing. As my experience goes, as I've already told you, there is a website that we have where there are links to joining a WhatsApp group also. In that WhatsApp group, there is a regular discussion of investors, and a lot of times people are extremely perturbed by the fact that this REIT has fallen by 2% and 5%, 2%, 3% and so on. Whereas equity markets, the variations are much more huge. Now why that happens is because they are a lot of equity investors. They are looking at variations in equities, but they feel that REIT should be far more stable product. But then, of course, it's an equity product, so it depends on the market. However, what really happens is that the REIT increase is limited. So these variations can perturb the investor here. And the price watch can demoralize an investor in REITs because the mindset of an equity investor can be very different. So REIT shortcomings for an equity investor, because he has a different mind frame, is because REITs need patient capital. This growth is slow with increments in both price and incomes, and they need longer time frames. So equity investors should actually educate themselves first, because it's actually a very different instrument with a different mindset. So summing it all up, equity and debt investors should actually look at REITs as differently, because the aim is stability with a mix of both features. It's a different product. Secondly, consider it as a separate asset to build a portfolio with a separate existence from the current allocation that you have. Secondly, the inflation hedge will kick in over a period of time, as the rise in rentals will accompany the rise in underlying values. Thirdly, the diversification and low correlation with other assets makes it an ideal asset if you look at it in the correct perspective. That is how REITs can be useful to any investor in the longer run. Thank you so much. Do comment and do write to us. Thank you so much for watching this video.